Go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Ayesha Tariq. She is a market specialist, and today, on a very special episode, we are going to unpack her financial Substack, which is, in my opinion, one of the best out there at the moment for your sort of retail investor, which, I mean, is always in my front of mind. It's the institutions can do whatever the fuck they want. They can go to whatever they want. They can, use their own people. We like to focus on the retail guys. Ayesha, how are you?
Fine, thank you. And thank you so much for having me.
One of the things I like about your Substack is your style of writing. It's got such an easy flow. It's sort of, you're talking to a 3-year-old. It's like I can take what you write and then digest it and like explain it to my child, which is so important because I find a lot of macro and microeconomists and analysts talking on this high peer level. And it's just like, dude, yeah, okay, cool. Speak to each other like on the phone at night, whatever. But for the general public, it's really hard to follow. And if we want to educate people and we want to uplift them and to that level, we have to write at a level where they can understand. So is that something that has always come naturally for you, or where does that approach come from?
So let me start off by saying that, of course, I love writing. I've always loved writing. So I've been writing since I was 16. I've written for various newspapers back home. And I think that comes from my love of reading, as you can see, all the books behind me. So, yeah. Basically, so when I became a corporate banker, I started my career as a corporate banker, right?
Okay.
But I never studied finance. Okay. I've always loved economics, but I never studied finance.
Yes.
I studied marketing. So I was all ready to go and have a career in marketing, Unilever, Procter & Gamble, all of that.
Yes.
So when I got into corporate banking, I had to understand a lot of these things that, all the treasury guys say and
the lingo,
especially. Oh, yeah. And, bankers, they love their lingo.
Yeah, they do.
They love their,
they love their
They
like sounding, they like sounding smarter than they really are. They like making you feel dumb.
Absolutely. But for me, I didn't really like that approach. I liked the everyday man's approach, So why make things more complicated than they really are?
Yes.
Simple is always best. And then when I came to the UAE, I think I was dealing with people from various backgrounds, nationalities, languages. So the first conversation you have with a client is always either about the market or sports.
Yes.
Right. So while I kept, in touch with the cricket scores or the sports scores as you
so important.
Yes. But we also had to talk about the market. So I had to tell them what's going on, give him my banker's feedback.
Yes.
But obviously, I didn't want to use the same words. And I wanted to make it easy. And I wanted to have a conversation like I'm having with you or with anybody else.
That makes sense.
So when I started writing, I felt like there may be a gap that I could fill for people.
Yes.
And try to explain things the way I understand them.
Yes.
So when I try to study something, I break them down in this way.
Yes.
So what you're reading is actually what I've read and the way I've understood.
I love it because that's how I am. Let's get into it. So on your Substack, ayeshatariq.substack.com, we'll put the links down every weekend. You the newest one is the Halloween edition. Completely loved it. So you go through your market recap, like what is happening in the market. Then you'll have your little special, which is this one you titled there, the inverted yield curve, which I got a big fright there. I won't use too many words there. That's the one where I'm going to stand. And then you talk about earnings, and then you go around the world. around different markets. That's where we're going to stand still a bit. And then you go to the week ahead. We just had the FOMC meeting, and I don't know about you, but I was a bit surprised, just in terms of Powell saying that the Fed would not hesitate to go back if tapering had the unintended consequences. And that, together with the VIX being at 15, to me is very dovish, but I could be wrong because most evidence that we have is anecdotal at best. What is your take on the FOMC meeting?
No, you're absolutely right. I think he was very dovish. I mean, for what it's worth, I think Powell is doing a great job with these speeches. He's very measured in his approach, very calm. And I love the way he takes words and, deflects them. Oh, yes. So he's doing a brilliant job, I think, at least keeping the public in check. Okay.
Yes.
And you could see that yesterday, where so when this happened with Ben Bernanke back, in 2013, the yields just went crazy, right? Yesterday, nothing happened. They hardly moved.
I think he's shifting it to whoever's going to come past or after him. I think he's just like sort of, okay, let's contain this, and then it's someone else's problem. Okay, let's go to the yield curve. What exactly is, I mean, everyone should know at least what a yield curve is, but what is an inverted yield curve?
So so we know what the yield curve is, right? It's the price, it's the yield or what the return that you get on bonds, right?
Yes.
So you have different maturities of bonds, meaning that you have 2-year bonds, 5-year bonds, 10-year bonds, 20-year bonds, 30-year bonds, and so on. So basically you have a yield for each, or yield or return for each and every maturity. So when you plot these along the graph, okay, you're supposed to have a very nice looking
slope
upwards. Yes. Very nice, because naturally something that's far out in the future is more uncertain. And if you're locking up my money for 30 years, you should be paying me more, right?
Yes.
So ideally, the longer end of the curve should be higher and the shorter end of the curve should be lower.
Okay, that makes sense.
But sometimes what happens, the curve goes the other way. So what happens, the lower end of the curve goes higher and the longer end of the curve comes down.
Okay.
So the curve inverts.
So 2 questions. Why does that happen? And what is the sort of ramifications for that? Let's say hypothetically it should happen.
Okay. So usually the short end of the curve is controlled by the Federal Reserve through their open market operations or bond buying or their policies.
Yes.
Right? They set the rate,
powerful
the
tools that they have to their disposal.
Absolutely. Absolutely. So what happens is sometimes when rates are being raised, they could be raised too fast.
Yes. Okay.
But the long end of the curve doesn't respond and doesn't increase at the same pace. Okay. And this could happen for a number of reasons. And one of them being the international market. So in the international market, when the return comes down, obviously bond prices go up, right? So what people start to do is people start to invest on the long end of the curve. They start to buy bonds there because the bond yield is still better than their yield. So what I said in my Substack, for example, think about Europe, where they have negative yields, but so you'd still earn more if you're investing in the US.
Yes.
Comparatively,
I think, yes. I think I had that conversation with Alfonso Picatiello. He's basically said something along those lines. So yeah, it checks out. Yeah.
So then what happens, you start buying at that end, the long-term bonds, 20-year, 30-year, right? So the prices start to go up. When you buy more of something, prices go up, right? And as the prices go up, it shifts the yields down. So you see what happens?
Yeah, not good. I mean, and that's
So your short term goes up, your long term starts to come down, and you get a inverted
yield curve. And that's where my fear is for subsequent years of negative market returns. And it's getting very real now, and everyone looks like a genius, but it could be jawboning for a couple of years down the line.
So look, I'm not saying that it will happen.
No, probabilities. No, I know. I'm just saying it's a real scary thought, because all the ingredients are there.
Yes, and it happened very recently. And why it could happen is because of the inflation, right? So if the Fed decides to increase the rates faster than usual, or by a quantum of more than 20.25%. So instead of 0.25, they go like 0.5% every time. So that sends the short end up much higher. And as a result, your curve could invert. Now, usually, even if this happens, it happens for a very short period of, it's happened quite a few times, but for a short period of time.
Okay.
When it happens when it stays that way for a longer period of time, that's when things start to get tricky. And it's always been the case, or at least it's been seen in the last 3 or 4 times that this has happened. Within 12 to 18 months, you get a recession. Okay.
Wow.
And we don't like recessions.
This conversation just went very dark very quickly. I don't want to let that word. I mean,
let's
move swiftly, because no one wants a recession. Let's just keep printing dollars. The 1.7, speak about that, the 1.7 trillion bill, budget reconciliation, whatever you want to call it. Where do you see that going, or where's it going to go? So, I mean, we talk about industry rotation or sector rotation. So for investors, where do you sort of see that going?
So look, obviously clean energy is a huge thing now, right? And we just had the COP26.
Sorry, I'm laughing, but that was what, to me, one of the biggest, I don't know, like it was just a joke. It was, so here we go, private planes, we go to the Trevi Fountain, we throw a coin, and we hope everything goes well. I've been to the Trevi Fountain. They should have just asked me, does it work? Hope is not a strategy. This is PR nonsense. It's like, okay, but anyways, yeah, it's big. It's the climate, yes.
Well, look, we all understand that ultimately we have to do something about it. Okay, we can't keep living life this way, right? You have kids, I have kids, and we want a better future for.
But the politicians, family. I mean, okay. So climate is one.
Maybe they're not. Yes.
Yeah.
So maybe they're not going about it the right way, but let's say,
okay,
in terms of our stock market and stock picks,
financial market is decoupled from reality. So yeah, I suppose I know what you're saying is, if it let the financial market sort itself out, we'll keep making money, and then we'll sort of worry about the real world on the side. I get it. All right. So climate being one, what would be the other?
So healthcare is another big thing.
Yes.
Right. So they're going to be spending a lot on healthcare. I think one other interesting sector to look into, and I think I've been speaking about this a little bit, is real estate. Okay. And when I say real estate, senior citizen homes, healthcare real estate, like healthcare REITs, these could be very interesting plays actually going forward, right?
That's an interesting
so they're also going to be spending a lot of money on education, on kids, welfare. So anything in and around that.
Edutech, any of those, okay.
Anything in and around that. So these are some themes that have come out of the bill. We'll know more as we go along.
Yes.
But I do really think the clean energy thing is pretty interesting. We have a pretty good set of solar names. We have some nice ETFs over there, and they're picking up and doing pretty well.
Very. It's not as sexy as the metaverse, but I guess dollar cost averaging into an ETF isn't like I said, as sexy as going into the metaverse. But I would say that's a very good option and a very good bit of good information for the listeners. Ayesha, thank you so much for coming on today and unpacking that brilliant Substack of yours. If people want to follow you, where can they do that? And what are some other things that you're busy with?
So you can follow me on Twitter, you can follow me on LinkedIn, and of course, if you subscribe to my Substack, you'll get a nice weekly roundup every week.
And we'll put those links in the comments. Thank you so much for joining us. To our listeners, peace,
Thank you
love,
so much.
and prosperity. I will catch you in the next one. Cheers.